My name is Fred Kuhn, and I'm with Governing Magazine. Today I have two experts who will examine this topic for us and provide you with some insight on advantages of setting up a similar program in your state. Joining me today are Jonathan Jones, Director and Senior Product Manager, Bank of America Merrill Lynch, Global Commercial Banking Liquidity Product Management, and Ray Maramihio, Deputy Treasurer, Investments at the State of Nevada. Now, each state has its own statutes describing permitted collateral types and pledging requirements for all balances related to public agencies within their states. Some states require a dedicated collateral model with individual pledging coverage for each public agency. Now, a pooled collateral model requires banks to pledge collateral to a statewide administrator to protect all the public fund deposits accepted by the bank from agencies within the state. The program serves as an alternative method that allows financial institutions and local government agencies within the state to participate together in pooled collateralization of their deposits in an efficient, cost-effective, and safe manner when collateralizing public funds. Now, in recent years, several states have moved to the pooling method of collateral.
Public entities, most of which require full collateralization of their public deposits, really have been confronted with the perfect storm of challenges, and that's how I'd like to start the past few years as a result of a couple of things. One is diminishing deposit returns coupled with lower tax revenues. This has resulted in increased budget deficits. So when I think about the factors that really impact these public sector entities, the first that I would point to is really the lingering effects of the financial crisis. Ultimately, this has forced many public entities to review their investment policies as well as their collateral coverage ratios. Over time, this has resulted in fewer investment alternatives for excess liquidity, as well as lower yields on the handful of options that have remained with less supply to meet the demand. At the same time, banks started to maintain significantly higher liquidity reserves well above historical standards. The liquidity reserves include securities collateral, and this reduced the value and consequently the yields on deposits requiring collateral, much more pronounced in dedicated states. With those factors at play, you also had Fdic assessments, which have increased due to the need to replenish the deposit insurance fund, which is usually passed back to clients through a balance fee assessment or lower yields, which further compress returns. The next primary factor I would point to is the low rate environment that everyone's aware of. The Fed set the target range for the Fed funds rate at 0 to 25 basis points back in December of 2008, and we're here 3.5 years later and that hasn't moved. Also, the Fed's come out and recently pledged to maintain low rates through late 2014, which will continue to put downward pressure on deposit rates. The rate environment, coupled with fewer investment alternatives for excess liquidity, continues to create a very challenging dynamic. Finally, I would point to the regulatory changes designed to improve the stability of the financial system. The first one, which we talked about a little bit already, was banks are held to higher liquidity standards. This is not going to change anytime soon, and with some of the new regulations that are going to be put in place globally, this will likely be strengthened as more of those come to fruition. Additionally, we've had full Fdic insurance on non-interest-bearing deposits for a good amount of this time, and this is set to expire at the end of the year. As this expires, it will increase the collateral requirements broadly to support public entity deposits, which could lead to increased collateral costs or more downward pressure on rates. One option that has been considered and is utilized today is a Federal Home Loan Bank letter of credit, which is accepted by most public entities as an efficient, flexible alternative to pledging securities and has been really an effective approach. So those are really the key factors. What I would also say is maximizing the value of public deposits and efficiently managing collateral will continue to be of the utmost importance for clients in the current environment and in the future.
Now, Ray, I understand where you work. The state of Nevada changed legislation and moved from a dedicated to a pooled collateral approach in 2003. What are the benefits that the state and its agencies have seen from this pooled collateral program?
Well, thank you, Fred. Well, there are a number of benefits from the pooled collateral approach. One of the benefits is it allowed us to create a uniform process for collateralizing public deposits. Prior to the pool, banks and public agencies had to come up with their own system for managing their collateral. As you can imagine, this system can differ from one public agency to another. In the pooled collateral approach, we were able to create a systematic approach to monitoring and managing this collateral. And because of the systematic approach, we were able to increase transparency in the process. In short, the process became predictable. Once we've educated public agencies in the pooled approach, they knew exactly what to expect. We were able to consistently provide updates to banks and public agencies on a regular basis. With the pooled collateral approach, we were able to streamline and simplify the audit process. Public agencies go through an annual audit regarding their compliance with collateral. Essentially, what this means is on an annual basis, all of the public agencies within the state would receive annual audits from their external auditors. Essentially, what we've done is handle this part of the audit for our public agencies. We directly respond to the auditors with the exact information they need to satisfy this audit. Through education, public agencies have responded well, and I'm happy to say that our program within the state of Nevada has gained support and widespread adoption. Nowadays, public agencies actually want their banks to be part of the pool program instead of outside of it. But one of the obstacles early on was that there was a perceived loss of control by agencies. What I meant by this was that public agencies felt like they didn't have any control in the collateral process, but they were still ultimately accountable for compliance. What's great about the pooled approach is that the process was simple, but it was also rigorous. It was also transparent. Once public agencies understood the process and saw how compliance can be systematically addressed, they felt comfortable joining the program. Banks are required to pledge collateral for any portion of public deposit that's not covered by Fdic, or for the case of credit union, NCOA insurance. We call that uninsured portion the uninsured public deposit. Now, in Nevada, banks must maintain at least 102% of collateral against uninsured public deposit. So on a daily basis, participating banks must report their aggregate level of public deposits and the uninsured portion. The pool program then calculates 102% of that uninsured portion, and that is the amount that must be pledged. The pool program then independently prices this collateral pledge to get the total market value. What we're trying to do here is we make sure that the collateral pledge meets the 102% minimum. Mm-hmm. All collateral is held in a third-party custodian under the pooled collateral program name for the benefit of public agencies. Transactions in the custodial accounts are actually controlled by the program. Now, daily reports showing deposit and collateral levels are then posted on the program's webpage for everyone to see. Then on a monthly basis, we reconcile everything, and we involve banks, public agencies, and custodians in that process. Make sure that your investment policies can adapt to the changing financial and regulatory landscape. You should also speak to states that have these pool programs in place and try to get their input, get ideas from them. Once you do that, you build your case to get senior leadership buy-in. Communicate the tremendous value this program delivers. Talk to your public agencies. Educate them. Explain how this program can enhance value for them. And lastly, I would say just keep things simple and transparent.
From our perspective, maximizing the value of deposits and efficiently managing collateral will continue to be of the utmost importance for clients in the current environment and in the future when you think about the regulatory environment that we talked about. We feel one opportunity to optimize the deposit structure for public clients is to consider this pooled collateral method, as this provides an excellent opportunity for public entities to manage collateral, to drive efficiencies by streamlining their processes, and to reduce risk through a centralized framework. Also, one other alternative that we feel is important to consider is potentially utilizing a Federal Home Loan Bank letter of credit, which is accepted by most public entities today and is an efficient, flexible alternative to pledging securities while keeping the safety of public deposits top of mind.
Well, we appreciate your joining us for today's discussion on the benefits of pooled collateral. And I want to thank our two experts, Jonathan Jones from the Bank of America Merrill Lynch and Raymond Remigio from the great state of Nevada for their insight and expertise. If you have any specific questions, you can go to bankofamerica.com/government to get information from them. Or if you want to send an email to me or Raymond, we'll be able to answer that at publisher@governing.com. Please keep it here on governing.com for another governing podcast coming shortly. Take care, everyone.